We now have the pleasure of inviting our second keynote speaker. Mr. Prashant Jain, one of India's best-known and successful fund managers, is co-founder of 3P Investment Managers, a firm focused on long-term investing. Prashant Jain was Chief Investment Officer at HDFC Mutual Fund from 2004 to 2022. With over 3 decades of experience in Indian equities and recognized as India's most awarded fund manager, Mr. Jain was the first in the country to manage over 1 lakh crore in equity funds. He holds the distinction of being the only fund manager in India and one of the few globally to have continuously managed a scheme for over 28 years. Mr. Prashant Jain, it's a pleasure to invite you to share your thoughts on Indian equities in a changing global and domestic environment.
Good evening, friends. It's an honor and a privilege to be speaking here. Nilkant, thank you for that really solid sharing your views on the economy, and when I listen to you, the economy, which is otherwise so complex, appears to be a bit simpler. All I will say as far as the economy is concerned is I think India has great demographics and it has the tailwinds of remote working, which is leading to large number of jobs being created in India through GCCs, and therefore I think India should continue to grow at a decent rate. It should be one of the world's fastest growing large economies. And I think most important, the volatility of India's growth is amongst the lowest in the large economies of the world. And let me also share with you one favorite line of Ruchir Sharma. He says that India disappoints both the optimists and the pessimists. So I personally don't expect India to grow much faster, but at the same time it should continue to grow at a fairly decent pace. Let me now come to corporate profitability, because that is at the foundation of what equities can do and what can we expect of them. It is interesting to note that India's corporate profits to GDP ratio is now broadly around 6%. And this is very close to the previous highs that we saw pre-Lehman. I think it was slightly higher, around 7%. We have come a long way from the lows of 1% profits to GDP around COVID. When I look at corporate profitability across sectors, I find very little scope for margins to improve. Corporate profitability is fairly good despite extremely low leverage, and I would find it very difficult for corporate profits to materially outgrow the nominal GDP growth in India. It is also interesting to note here that India's nominal GDP growth has slowed down, not because the real growth has slowed down, but because the inflation that we are experiencing, or the GDP deflator, is much lower than what it used to be 15-20 years back. So I think nominal GDP, and Nilkant is a better person to speak on this, but I feel nominal GDP should grow around between 10-12% a year. And if you look at the GST growth rates, that's also growing around 9-10% a year without any changes in the GST rates. So I think that's a fairly decent, reasonable, realistic estimate. So I would be, my best guess for corporate profits would be about 10-12% CAGR for the foreseeable future. I think it is here that the foreigners have misread the India's profit growth rate. The high profit growth rates of the last 4-5 years were primarily because of the extremely low profits to GDP that we experienced around 21. And that is why this year results are coming as a shock to many investors, and we are seeing reasonable earnings downgrades. It is also interesting to note that India does not have any non-linear, genuinely R&D driven, innovative businesses. So I think unlike the US, where profits have grown far faster than their economic growth, I think in India that is quite unlikely. Now, moving on to markets, I think what we have seen in the last 2-3 quarters is a 25% correction in P multiples of Nifty, and 15% is the correction in Nifty from the peak levels, and along with that we have had almost 3 quarters of time correction, and current year Nifty earnings are growing around 8 to 10% a year. So you had in all put together the time and price correction, the P multiples have moved lower by about 25%. Currently Nifty is trading around 16 or 17 times for calendar 26, which I think is the right way to look at the markets, because in about 3-6 months time almost everyone will start focusing on calendar 26. I think a 16p, 17p, even for a 10-12% earnings growth is not excessive. It is quite reasonable, because what has changed in the last many years is that as inflation in India has moved lower, our cost of capital has also drifted lower. I have spent my entire career tracking the gap between US and Indian interest rates at 4 to 6%. And currently that gap is running between 2 to 2.5%. So essentially, as India has opened up its economy post 90s, as supply side reforms have taken place, India's inflation has structurally moved lower. The gap between India and US inflation has moved lower. The gap between India and US cost of capital has moved lower, and consequently the cost of capital in India is also moved lower. And in view of this lower cost of capital, I feel a 16-17 PE multiple for a 10-12% earnings growth is pretty reasonable. Now what that implies is that if you take a 3-5 year view, 1 year in equities is extremely hard to forecast, and what has happened last year is once again a very good reminder of that. But if we take a 3-5 year view, I feel that the returns from large caps from Nifty should be very close to the nominal GDP or the profit growth rate, which is about 10-12% a year. Many of us will find this extremely disappointing because of what happened. The returns in last few years have been extremely high. But let us not forget that those high returns were not because of higher nominal GDP growth rates. They were primarily because of a much lower base set during the COVID. So it is often said in equities that the best investments are made in the worst of times, and the biggest mistakes are made in the best of times. So whenever you invest in a crisis, as the crisis passes, you will find that your returns are extremely high, because in crisis the valuations are extremely low. So this is what happened to equities in India as well, and to my mind the returns of last 4-5 years post-COVID are primarily because of the low base, and that is not a reasonable reason or a good reason, sound reason to extrapolate the same high returns into the future. It is also interesting to note that if you look at the returns of Nifty post 2000, last 24 years, it is around 13% a year. So when I was till 2000, we used to routinely say expect Sensex Nifty to compound around 15-17% a year. But that was a time when India's inflation used to be 9%, when nominal GDP used to grow around 15-16%. So that was a good estimate then, but I think it is not reasonable to expect those kind of returns in this lower inflation environment. Moving on to beyond Nifty, I think this is one of the most boring markets that I have experienced in my 35 years as an active manager, because no matter which sector I look towards, it appears to be reasonably fairly valued. There are no sharply overvalued sectors. There are no sharply undervalued sectors in this market. Just around COVID, it was the other extreme. There were hugely expensive sectors and there were dirt cheap sectors. For example, PSUs, corporate banks, they were dirt cheap, power utilities. But the last 5 years, those excesses have corrected at both the ends. What was sharply overvalued has moderated, for example, the consumer staple companies, and what was deeply undervalued, like the corporate banks, like the PSUs, the power utilities, the defense companies, they've gone up anywhere between 6 to 10 to 15 times. So therefore, the excesses have disappeared and there is very little dispersion in valuations in the large caps across these markets. So in a way, it's a very challenging environment for an active manager because people like me hope to make a living by outperforming the markets, and which is possible when you see excesses in the marketplace. So these are markets which I think support a fairly diversified investment strategy across sectors. The only excesses that we have been pointing out, I have been pointing out for last 6 to 9 months is on a cap basis. So if you look at what has happened in this market, the small and medium sized companies have massively outperformed the large caps. And when you talk to people, 9 out of 10 people, at least 3 months back, 1 month back, they would say, and they would argue with you vehemently, that why they believe small mid caps will create more wealth. So let me share with you some reasons as to how this opinion has been formed and why it is incorrect. So what happened in COVID, and that happens in every crisis, the large caps fell about 30%. So a 100 rupee index in large caps became 70. In a crisis, no one wants to buy small mid caps. They fall much harder. So they fell to probably 20 or 30 rupees from 100. And as the economy, as the markets normalized, large caps that should have gone from 100 to 200 over 5-6 years, as they double in 5-6 years, they instead went from 70 to 200. So money became nearly 3 times. And that's a 20-25% CAGR, which is the higher returns we discussed just minutes back. So, but in the small and mid caps, the recovery took place from 20 or 30 all the way to 200. Now that's a massive return. It's a 30 to 40% CAGR return. And that is because percentages don't work linearly. If you fall 50% to go back, you go up 100%. If you fall 70%, you go up 200% to go back to where you fell from. And that is precisely what happened to small and mid caps. And interestingly, if there are 20 crore demat accounts today, not unique but all put together, 15 crore of these demat accounts were opened after COVID. So 3 out of 4 investors in India, or 3 out of 4 demat accounts in India today did not exist prior to COVID. So this 3 out of 4 investors have no experience of equities before COVID. So all they have experienced is the journey from 70 to 200 for large caps and from 20, 30 or 40 to 200 for small and mid caps. And that is why the majority favors the small and mid caps, because they have experienced much higher returns. And as the majority opinion or majority money moved into small and mid caps, they did not stop at 200. Things have gone much beyond in small and mid caps, and they went all the way to 3, 4, 500. So I think, and when you talk to this body of investors, they will trust their experience far more than anything else. And this is not the first time. Similar things have been experienced in every crisis. So post 2000 crisis, 9/11, post Lehman 2007-8, post even tapering 2014, and now post COVID 2020, from that low base, small mid caps always outperform, and that always sucks in a new generation of investors, and which has happened this time around as well. So I think this This is what explains this popular belief. This is what explains the significant overvaluation in small and mid caps. And I think it is good that last few months we have been seeing a significant correction, because the longer it would have taken, they would have taken to correct, the bigger the excess would have become. I think the Indian businessmen, the owners of businesses have realized this very clearly. If you look at the massive dilution, the massive activity in IPOs, NFOs, QIPs, OFS, I mean, it tells you the stake of private promoters, excluding the government, it was 46% 4 years back. Today it is under 40%. So there has been a rapid sell down by business owners, massive capital raising by businesses. I think it's absolutely in order, because that excessive supply is what has led to this correction in the markets. So I feel where are we today? The small mid caps have clearly corrected a lot more than large caps, but I still feel the extent of overvaluation in that space was so high that even today many of these companies do not make sense. I have seen companies go public where we thought the value was 100 and the IPO took place, believe me, at 1,000 rupees, 10x the fair value. So I think significant excesses get created in every bull market, and this was no different. But in the end, it all mean reverts. So I would say that the small mid caps continue to be overvalued in majority, and the risk reward clearly is in favor of the large caps. If you look at, there is also a belief that smaller companies grow faster, because people always say, for example, how can HDFC Bank grow faster than a smaller bank? But look at the data, because the bigger businesses I have seen on an average, they grow faster than on an average smaller businesses, because bigger businesses have a right to win, they have far higher strengths, and therefore you will rarely find an undifferentiated smaller company in the same industry growing sustainably faster than a large company. So I don't think smaller companies grow faster, unless of course you are a new business model and you are starting from zero. Then of course you can over time become a mid cap and a large cap, but that happens 1 in 50, 1 in 20 companies. On top of that, I think smaller companies carry much higher mortality risk. So when you compare the returns of a small cap index, the mid cap index and the large cap index, the churn rates in the small cap indices are the highest. So companies which simply fold up are taken out of the index. And if you adjust those returns for this higher mortality, I think the returns of that index also will be commensurately lower. Let me just highlight one more example, or why that should convince you that these businesses were indeed overvalued. For the first time in the history of Indian capital markets, we have seen MNCs, the parents, aggressively sell down their stakes in Indian arms. It has never happened before. They used to increase stakes all along, but for the first time you have had 7-8 multinationals aggressively sell down stakes. And I think the reason why it has happened is simply these valuations became too high to hold on even with a 10-year view. And that I think is a clear evidence that how, and Nilkant so rightly said, that China continues to expand its share of manufacturing. So while China plus one is a good narrative, but I think it will take us much longer to increase our share of manufacturing, because competition is really, really tough. This market also has been driven by narratives, and it always happens in every bull market. So what were the narratives in this market? Small mid caps was one narrative, China plus one was one narrative, renewable energy was a third narrative, electric vehicles were a fourth narrative. So the narratives are broadly right, but the markets price in too much, and what would take 10 years, 20 years in the real world, the narratives, the mass hysteria towards certain stocks brings it all together in 1 year. So I think this is what happened this time around, and in a way I am happy that these excesses are being corrected. So to conclude, I think this is the outlook for India's economy is extremely good, and I am not an economist, but based on what Nilkant says and what we are experiencing and what common sense suggests, I think we should grow around 6% a year broadly, maybe hopefully 7% as Nilkant says. Profit growth, to my mind, should not be more than 10-12%, and large caps should continue to double our wealth every 6 years or so. And to those of you who find this less exciting, let me give you one simple example. And I know there are many friends here from HDFC Bank, so nothing against bank deposits. But if you invest in any fixed income instrument in India, it will take you 14 years to double your money at 5% post-tax, because fixed income is taxed at a full rate. If you do that, invest in an index fund, or I think it should double every 6 years or so. So in 14 years, your 100 should become 500, and if you double that cycle once again, in 28 years, 100 becomes 400 in fixed income, and it should become 2500 in a passively managed fund. So I think equities can create huge amount of wealth, but as Mr. Buffett has said, they are instruments that transfer wealth from the impatient to the patient. So I think equities create huge wealth, but they take a long time. And I have 10 seconds left. Let me also tell you the journey of Sensex, how it has come from 100 in 1979 to 75 or 1000 currently. If you double 100 9 times, like 200, 400, 800, you will come to 51,000. And if you double it 10 times, it will go to 1 lakh. So you will appreciate that the Sensex has doubled between 9 and 10 times in the last 45 years. That is roughly every 5 years. And that is because India's economy has, in rupee terms, has also doubled at nearly the same rates. And because of lower inflation, since economy should double every 6 years or so, I think we can expect the same from Sensex as well going forward. Thank you.